Hi, this is Stephen here from Share Navigator, and today we're going to share with you the Poormans Covered Call strategy. So here's an overview of what we're going to cover, and you can pause the video if you like, and we'll get stuck straight into it now. So Poormans Covered Call, is it a neutral, bullish or bearish strategy? It's actually neutral to slightly bullish, in that it's very similar to a covered call. You want the share price to reach a certain area, but you don't want it to go too far up, and you certainly don't want it to go down. So it's neutral to slightly bullish. So it's best to apply this strategy to a sideways trending stock. So how is the trade constructed? Well, it's called a poor man's covered call because it's really just a covered call. Take the stock out of the covered call position and replace it with a long call instead. So long calls are cheaper than buying stocks, and therefore, that's hence the name, the poor man's covered call strategy. So a couple of rules that we like to do. We like to buy the calls in the money, and the reason is that when you buy in the money calls, you're paying less time premium for the call options. Okay, they're going to cost you a little bit more money to do the trade, but you're paying less time premium, and it makes it easier for you to make a profit when it comes to the second part of the trade. And we also like to go at least 6 months out, if not a year or 2 years out on the call options. All right. The second part of the trade is to sell a call option out of the money and out only 1 or 2 months in this situation. So it's really a combination of call options. One is a long call that has an expiry 6 months to 2 years, and the second part of the trade is your shorter call option, which is out 1 or 2 months. So let's place a trade in our simulated platform to give you a better idea. So here we are in our Interactive Brokers demo account. This is a great place for practicing, guys. You can't make any mistakes. So we're going to go on our options now, and we're going to do an example. I see here Hewlett Packard is open, so we'll do an example with Hewlett Packard. So this is what we're talking about, the time frames. You can see here a lot of different expiry dates, and we see call options right out as far as 2017, 2016. So it's the 25th of May 2015 when I'm making this video. So we'll go out, let's say 6 or 7 months, we'll go out to January 2016 and see what calls are available. So I know that Hewlett Packard is trading at 34.83, so I want to go in the money. So in the money or calls is when the strike price is below the current share price. So I see here that at the $30 strike, the bid ask is $5.75 to $5.40. So I'm happy enough with that. I'm paying about 70 cents in time value. It's not too expensive, so I'm happy to place this trade. So I click on the asking price. That's going to bring up the order management window. So this is the first part of the trade. I'm buying one Hewlett Packard, January 2016, $30 call option, and they put the limit price in here. Now, I'm just going to accept this because it's a demonstration video. But I would normally haggle with the market here and try and get as close to that bid as I can. We'll click on preview order, submit the order, and this will be the first part of the trade done then. You can see it's filled. So now we own a long call option of Hewlett Packard. So the second part of the trade was to sell a call option out about a month. So a month out would be, let's say, the June expiry. We'll look at June the 19th. And we're going out of the money this time. So out of the money strikes for calls, our strike price is above the current share price. So the current share price is $34.84. So we might look at the $36 strike here. We're going out a month, and you can see we're going to collect in 77 cents in premium. So we click on the bid price there. So this time we're selling one Hewlett Packard, June expiry, $36 call, and we're going to collect in 77 cents. Click on preview order, submit the order, and hey presto, we're filled in that as well. So we show you what that looks like for real in your account. You'll see here, this is going to update shortly. Here's your long call position, and you can see all of the different bits and pieces here. And then the second part is your short call position. So anytime you see a -1 in your position, that means you're short on that particular option. Okay, so that's how you construct the trade. We're going to go back to the presentation now, do a real life example that we've placed in our own account with Apple. So here we are. Let's get to a real life example. Apple was trading at $132.54. Our target price is $140 for Apple. So there's a number of ways we could have played this. We could have just bought the stock and let the shares rally up to 140. We could have done a normal covered call, but we decided to do a poor man's covered call. So what we did was we said, right, we're not going to buy the shares up front, but instead we're going to buy the $100 January 2017 call options. And then we were going to sell the $140 July calls. So we were going to buy one call option, and then we were going to sell shorter term call option contracts off our long call option position. So the first part of the trade was we bought the $100 calls, and we paid out $37.40, or on a contract basis, $3,740. The second part of the trade was we sold one contract up to June 19th, $140 call. So we didn't bother actually going for July at the time, and we received $137 per share, or a total income of $137. So just one thing to note about this, in covered calls, anytime you're selling call options or put options or any options for that matter, the premium automatically goes straight into your account. So just be aware of that. Okay. So there's two ways we could have played this. That was the first way. We actually bought the long call and sold the call option straight away. The second kind of variation of this strategy is called the buy, rally, right. So we could have bought the shares at 132.57, waited for the shares to rally a little bit, maybe up to 136, 137, and then sold $140 calls. It's ultimately the same trade, but you're just waiting for a bit of a rally. And the reason is you're going to get more premium for those $140 call options that you sell. So let's get into some of the risk and reward in this particular strategy. Well, the bottom line with this, the risk in this strategy is less risky than simply owning the shares. And we're going to show you that at the end. There's an opportunity cost with this trade. Our upside potential is capped. We can't make any more money. If Apple goes to 140 or 150, we can't make any more money than if it goes to 140 because we've shorted calls at the $140 level. So there's an opportunity cost. And then, of course, the other risk is if the share price falls. So most likely in that situation, our long call position will go into a loss. So what's the maximum profit we can make? Well, our profit is absolutely limited because we've sold a short call. And our profit is equal to the premium we receive for the short call plus the profit on the long call position. So in Apple's scenario, our premiums that we receive is $137. We know that. But the profit on the long call, and I have estimated in brackets here, because don't forget, if we get to the expiry for the short calls, we still have a lot of time left to run on the long call position. And that means there's time value in those calls. And you can't exactly predict right now how much that time value is going to be worth because volatility can change. A lot of factors can change. So we can only estimate. So we estimated that the long call position will be worth about $42. So the profit we're going to make on that position is 42 minus what we paid out for the long calls was $37.40. So in that situation, our profit was $460. So our max potential profit is the 460 plus 137, which gives us 597. So calculating your return on investment. Return on investment is simply your profit potential divided by the amount you invested. Now, we invested $3,740 buying the long calls, but we immediately took income in. So really our initial outlay was $3,603. So it's what we paid out for the long calls minus what we took in for the short calls. So 597 divided by our outlay, which is 3,603, gives us a 16.6% return. And this again, it looks very similar to a covered call strategy when you actually chart it, but you'll see it's a bit wavy down here, and that's because of the time premium element on the long call side. As I said, there's time premium left in the long calls, and it's not exactly linear. So what's our break even in this particular trade? Well, again, it's really down like a covered call. It's down to the share price minus the premium you receive for the covered call. So we know that the share price of Apple at the time is 132.54. The premium received was 137. So our break even is going to be around 131.17. It's not going to be exactly that because again, time premium comes into play with call options and the bid-ask spread as well. But roughly that's where you're looking at expiry in the June particular calls. So at expiry, if the shares of Apple stay above 131.17, we will be in a profit position. So what's the effect of volatility in this? Well, we're saying to you on the long calls, you really want to stay away from buying time value and go in the money and try and purchase as little time as you can. But on the short call side, it's really best to sell those call options when implied volatility is high. The reason is you're getting paid more premium. In terms of time decay, there's a positive effect on time decay on your short call side. So just remember there's a negative effect on the longer call side, but because the expiry to your longer call is greater than your short call, the short calls will decay at a faster rate than your long calls. And that's positive for you in the overall strategy. So again, this is really a Theta play here. So picking your strike prices, how do you go about doing that? We have our own little rules. We like to go in the money. We've told you that already on the long call side. But on the out of the money short calls that we're selling, we go out of the money as much as we can. And really we pick our target price where we'd normally sell the shares anyway. And you know what, you want to be slightly bullish, just out of the money slightly. What time frame? Well, on the long calls as far out as possible, we go 6 months to 2 years. And on the short calls, we wouldn't go usually any more than 2 months out. So looking at a normal covered call strategy versus a Poormans covered call strategy. So a normal covered call strategy for the exact same trade, we'd be paying out 131.17. For this strategy, we only paid out 37.40. Our total investment was, if we chose a covered call, would have been 13,000, and this one is just short of 4,000. And our profit potential on a normal covered call is 863. Now it's only 597 for the Poormans covered call, and that's because of the time premium that you've bought in the long calls. But our return on investment is so much greater. So your return on investment on the covered call is 6.5% if the shares get to $140, of course. But on the Poormans covered call, it's 16%. And the reason is you haven't outlaid as much at the beginning. You've taken less risk on the call side, on buying the calls versus buying the stock. The downside here is with calls, owning calls, you don't get dividends. And with owning calls and the covered call strategy, you do. And your profit is capped in both of them. So really, when you compare both of these strategies, it doesn't really make sense to do a covered call on a normal stock position as an outright strategy. You'd be better off going for the Poorman covered call route once you understand what you're dealing with call options. Okay, managing the trade. If the share price goes over our target price, what have we got to do? You've actually, with this one, it's slightly different to covered calls. You'd want to close down both sides of the trade. Because don't forget, you've sold call options at the $140 strike with Apple. If the shares finished at 145, you know, your broker would have to actually sell shares for you to somebody else. So you'd be short to sell shares in your position. So the best thing for you to do come expiry Friday, if the share price is over your short call target price, sell both sides of the position. Just sell them for a profit. You'll sell your long calls at a profit. You may be buying back your short calls at a slight loss, but overall you will be in the profit we discussed earlier on. If the share price stays below the strike price of the short calls, do nothing. The short calls will expire worthless. You will still keep the premium you received, and then you will do it all over again for the following month. And that's the idea of this strategy. You just keep selling these calls month on month on month and reducing the cost of your long call position. Okay, this is Stephen from Share Navigator. Please visit our website, sharenavigator.com. Share this with your friends via social media. It's free training. If you go to our website, you will also see some of our live trades as well. Thank you and bye for now.